Thank you very much for joining us today. Today we're talking with Donald Davies. Donald Davies is part of the talent pool. He's a highly accomplished specialist focused on corporate governance and SMCR. Donald, thank you very much for joining us today. Would you like to start just by introducing yourself and telling us a little bit about how you came to be involved with ICSR?
Yes, certainly, Ben. Thank you very much for the invite. ICSR was an unusual event in as much as I was speaking with someone who had joined you the previous week at a London roadshow, I think, who I was working with at the time. And he happened to mention, as I was being released from another contract, that he was in the business and seen an opportunity for me to possibly support some of the regulatory aspects that your firm were dealing with a client. That just by coincidence turned out to be governance and SMCR regulation.
So right up your street.
So right up my street, as they say. Perfect. So the timing was perfect.
And your background, how did you come to be a specialist in governance and SMCR?
So poacher turned gamekeeper. So my original work was involved in working for an American bank in the 70s, where I was a branch manager of a finance company. And I spent 15 years selling all range of products, investment products, mortgages, banking accounts to customers through high street branches. And there was a slight wind of change happening in the UK at the time. There was a shift towards more intrusive regulation. And what I sensed at the time was I probably needed to reposition my career and moved into more regulatory work than being part of the delivery of products. So I left financial services basically and effectively studied mortgage regulation. I studied law for a couple of years, but didn't complete the, not to become a lawyer, but to understand more about the layers of law. And that helped me build up the foundations of doing what I now do today. So in effect, I've got this yin-yang hat, and I can practice operational aspects of a business whilst understanding the undercurrents of rules and regulations that underpin them.
And it's the perfect embodiment of the type of person we want within the talent pool, somebody who's practiced client side before becoming a professional advisor. You understand the issues that the clients are having to address from a business perspective. So
I think the lived experience aspect really is working really well for this opportunity. The fact that you bring in people who have significant experience and can present that significant experience as practitioners to your clients is very, very different to typical consulting supply businesses, where they have maybe very educated people providing consultancy services, but they don't necessarily have any cold-face experience in knowing what impacts some of the things that they recommend may have, and I do have.
I think Kenneth often refers to it as being able to take a pragmatic approach to the advice we provide.
Absolutely.
Donald, you've talked a lot about your background and your history in the world of governance and SMCR. What's new from an insurance perspective in the way firms are approaching their governance and internal control frameworks right now?
There's been an enhanced scrutiny by regulators, not just in the UK but worldwide, that you will probably be aware of in the sector, not just in insurance but in any financial services, that the products and the way that products are sold and delivered are under more regulatory scrutiny than they ever have been. And what's been identified in some of the research done by regulators is that a lot of the failings of organisations to meet regulatory requirements is because of poor governance. The governing of the business has been very, very weak. A great example in the UK of that is the failing of RBS. The Royal Bank of Scotland failed, and you can read the report, it's quite an extensive report, but the FCA reported that the governance had failed the business, and therefore to strengthen governance in the financial services sector is now a de minimis, if you like. It's a must-have, not an optional step to take. So that's one part of the coin, if you like, and governance being, in my view, governance is what I could describe as a control mechanism. What the SMCR does is it puts the responsibilities of who is controlling to the individual managers. where it was the firm that they regulated before, and RBS as a firm was regulated, but no one in RBS was punished for the failings because the regulation wasn't in place to ensure that people were individually accountable. So we have this wonderful new regime now called SMCR, also known as the Individual Accountability Regime, and it has three parts: senior managers regime, certification regime, and codes of conduct. And those three parts make up the individual accountability regime, which is what the UK regulator uses. It expects good governance to be applied in applying the regime.
And it's interesting, you talk about the impact of the Royal Bank of Scotland case on that sort of shift in focus. If my memory serves me correctly, it's around that time that the Financial Conduct Authority emerged from what was called the Financial Services Authority. Is that correct?
It was pretty near the time. RBS and the global financial crisis, if you remember, was 2000, 2008.
Yeah.
2007, 2008. And the separation of the FSA, as it was then, the Financial Services Authority, which was run by Hector Sands at the time. He wanted to regulate ethics. There's a Mansion House speech back in that decade where he was talking about, I don't think banks are behaving very well. I think we should try and regulate their ethics. That didn't go down too well with the city or anyone else who might have been interested. Nevertheless, that was a start, if you like, of that principle being, if you like, a catalyst. The regulators, because of the review of the financial crisis, were separated into two regulators: the Prudential Regulation Authority, which deals with financial capital aspects, and the new regulator, the Financial Conduct Authority. And the key word there is in the middle name, conduct. It's about behaviour. So the FCA is the first worldwide conduct regulator.
It's interesting here you talk about the Financial Conduct Authority, Donald, and its sort of emerging role as it came out of that period when we went through so much change with the banking crisis. Where do you think the Financial Conduct Authority is going from here forwards in the way it regulates that part of its remit?
So there's two parts of that, really. There's the path that the UK regulator is taking, and that is to further their interest in behaviour and less so on principles or product creation. So whilst they have rules regarding how you design and deliver products in their rule book, they are now far more interested in how you're behaving in getting to that point. Because if you are badly behaving, you will badly make products that are not suitable for customers. Conversely, if you really understand the essence of good conduct and good behaviour, it will be in your organisation's DNA to make sure that you're thinking always about the outcomes of those products for your end customers and the community at large. That whole approach is informing other regulators around the world. So Ireland, for example, brought out their equivalence of SMCR last year, and they're stumbling along with that just now because the Irish players don't necessarily like to be controlled in any way, and that's just expected, I guess. The Australian financial services sector has a similar, and I heard recently that America is also thinking about bringing in an individual accountability regime, which that's the land of the free, so that's going to be very, very difficult to convince people to adopt that. But the UK regulator is leading on behaviour being a driver of good conduct.
It's interesting to hear you say that. I mean, I follow a lot of what comes out from the FCA through their news feed, and one of the messages I've really picked up is this shift that says we're much more interested, or the way I perceive it is they're much more interested in what they perceive to be people's attempts to do the right thing than whether they've ticked every box in a checklist that may not be relevant to every organisation. Is that a fair assessment?
Yeah, so if you go back to the Financial Services Authority, they were what was called a principle-based regulator. So they set out some principles and they expected firms to abide by those principles. So surprise, surprise, out came the checklist. Have I abide by that principle? Yes, I have. I'm therefore compliant. And they realised that approach failed. The regulator actually failed, and they acknowledged that they had failed, hence the separation of regulators into two. So they're taking a totally different approach to say it isn't about tick box exercise compliance anymore. It's about living and breathing the essence of ethics, morality, and good conduct. And if you live and breathe those aspects in your organisation as a embodied behaviour, using your word earlier, embodied behaviour, it is more likely there's going to be less harm for the customers, consumers, and the financial sector as a whole.
And hence, I guess, we see the importance from a corporate perspective of developing good cultures within the business that are led from the top down, but encompass the way that all of the members of that business behave in how they ultimately seek to serve the customers that they're there to provide products and services to.
Well, exactly. The history of top-down governance is a bit weak because, as we know from the RBS example, they said one thing and did something else. So the culture that was created is one of almost like a Janus, a two-face. You know, what the public see and what happens behind the scenes are two different things. And the UK regulators are trying to reduce, effectively eliminate eventually, but that's an ideal state, reduce the falseness of declarations. So for a firm to say, for example, that it has a zero tolerance for non-compliance in its mission statement, but knows it's non-compliant, is the fallacy state. And the regulator is fully aware that some companies still operate in that way, and it will try and deal with those by closer inspection and supervision as time goes on, or as they make mistakes, pick them up when they make mistakes. But they would rather firms didn't make mistakes and did the job properly in the first place, to your earlier point.
Essentially, I'm just reflecting back on sort of something we published an article on corporate culture a while ago, and we likened it to a super tanker. You know, it takes a long time to change direction, and I think that's probably a great analogy for corporate cultures. And you know, ultimately, a bit like corporate culture, the super tanker has somebody at the helm, as do businesses, and it needs that person at the helm to start the process of changing direction. And we come back to conduct and culture.
That is a perspective that many hold, and it's a good starting point. Because it gives the impression that someone is able to lead culture in an organisation. But you'll find if you look at it from an academic's perspective, which I am now putting my academic hat on, culture is an emergent phenomenon of conduct. So no matter who is enacting in the conduct state will create the culture of the organisation. It's not you can't appoint a leader to create a culture, because culture is the outcome of the collective conduct of people in a company.
Donald, you've been involved with a few engagements with ICSR clients now, and you've talked about how much you learn from every client you work with. Can you share a few reflections about what you mean when you say every client is different and every scenario is different, and some examples of things that you've learned?
What always interests me is some people are shocked when they realise that they should be doing something that they weren't aware of, and some people don't care. So depending on which client you're with or which function within a business you're dealing with, you will get different calibrations of that range. Someone who may know what to do but isn't quite sure, may not know what to do and is totally unaware, and in between is pretty much usually everybody else getting on with their job. Whereas in a regulated environment, each manager in an organisation has a responsibility to know what obligations they have to be compliant with their part of the business. And that's really what SMCR is all about. So I'm bumping into, since 2015, which is when SMCR was born. It came out in 2016 for banks, and it then rolled out to other entities thereafter. Is the evolution of that learning process is still in very, very embryonic stage. Very few organisations, whilst they have been obligated to implement SMCR, very few actually have implemented it from an understanding perspective. So they may have ticked the box to say, I've read that rule, or may apply this, or we've written a policy across here that applies to a procedure across there, and we might or might not have some internal control mechanisms to make sure that those things are working correctly or not. And what always amazes me is and I am biased, by the way, I'm very pro SMCR and governance, so yeah, you have to excuse the biased side of this, is the absence of knowledge, understanding, awareness and control.
It's interesting when I hear you say you're biased. My immediate reaction when you say that is I think clearly you've seen the benefits that come from SMCR and how ultimately it can do good for organisations in terms of the way they work. Is that a fair statement?
That arose from some studies I did when I was studying sociology about 10 years ago, and I bumped into a German sociologist called Max Weber, W-E-B-E-R, and Max wrote about authority systems and bureaucracy being the most efficient mechanism a firm can have because it's very efficient. And I harmonised with that way of thinking, because what I did was I then looked at how does SMCR compare with this sociologist thinking in the early 20th century. And in actual fact, when you look at what he was describing in terms of bureaucracy, in terms of good record keeping, delegation of responsibilities, good recruiting people who have good competencies and skills, it was almost as if SMCR as a framework had been copied from his authority system theories. In fact, I actually put out to LinkedIn that that's what I think they have done. So the interest I have is that this isn't a new. SMCR is quite new, 2015. But Max Weber's work goes back into 1910, 1920. And he wrote then about the efficiencies of bureaucracy. Well-run organisations with good policies, procedures, good governance and good management are the most effective mechanism you can have. But we seem to push against it. Industry tends to push against it. Financial services industries tend to push against it being an authority system that's imposed upon them. And the reason I'm saying imposed upon them is what the regulator is trying to do is condition those who they regulate to do things their way. And most enterprising firms, entrepreneurial spirit firms, want to do things their way. And that's where you have this disconnect.
And we come back to that wonderful word pragmatism that we talked about earlier, which is finding a path that respects the expectations of the regulator and harvests the entrepreneurial spirit that businesses need to thrive and succeed, I guess.
So what I did was, in writing the course we mentioned earlier, it opens with the dynamic. In the UK, the accounting body that governs corporate governance in the UK defines governance in a certain way. I've adopted it slightly, and I present governance, good governance, as being the balance of good prudence and good entrepreneurship on a seesaw, on a pinion. And if you have either out of balance, too much prudence drags your business down, you become extinct. Too much entrepreneurship and no prudence, and you eventually breach your regulatory obligations and hit a wall and usually lose your license. That's the risk you take in having too much entrepreneurialism. So I say good governance is about balancing the two in a pragmatic and practical way.
So Donald, you've talked a lot about the responsibilities that come with senior management function holder roles. What advice would you give to somebody newly appointed into such a role?
The key to understanding your role under the SMCR is actually understanding, first of all, the senior manager conduct rules, of which there are 4. If you bypass that step, one will be in breach because you have to know what they are to be compliant with them, but they also help you understand some of the expectations around your role. There are 4 rules. The 4th one is just making sure that you notify the regulator if anything they might be interested in. So we'll ignore that one for the moment because that's a given. Yeah. That should be part and parcel of the way all businesses operate now. The other three rules is that you must take reasonable steps to do something. And the reasonable steps obligation is now in statute. So it's a statutory responsibility. It's now in law. It's in the Financial Services and Markets Act. And it's now a legal requirement as well as a regulatory requirement. So the conduct rules talk about you must take reasonable steps to run your business in an orderly way, basically. Well, why wouldn't you? Yeah? You must take reasonable steps to understand the regulatory systems that apply to your function. So, well, how can you possibly do your job unless you know what rules and regulations apply to it? And you make sure that you don't delegate anything to someone who hasn't been assessed as capable and competent to take the delegation. So my first piece of advice to all senior managers coming into the role is get your head around those three obligations, not least because you have to abide by them to retain your license to operate. But in understanding them, and going back to the Weber example that we used earlier, in understanding the mechanisms of how you go about being compliant with those three rules, and the fourth one, makes your business more efficient and effective because you're not having to think of ways around things.
Donald, that's some great advice for a new manager. One of the things that strikes me, you talked about control environments earlier, and of course any management role is about creating the right control environments. Is there any specific advice or guidance you'd offer on that particular part of the responsibility?
The main strap line that I present, which it evolved about 14 years ago when I was working for a bank in Ireland, building a control environment for a bank that was failing, was to consider the question to senior managers, how do you know it's working?
It's a great question. Is there an easy answer?
And if they say, and they should, they under SMCR and under a duty as being a director of a firm or a senior manager of a firm, they should be able to say something on the lines of, I have internal control mechanisms which I apply. The activities I'm responsible for are reported regularly to me, good and bad. Where they're good, we continue, and where they're bad, we remediate. And I report that periodically to the executive or the board of the companies.
That's great advice. Thank you, Donald. Donald, thank you very much for taking the time to talk with us today. It's been a really interesting conversation and certainly a learning curve for me. Appreciate you taking the time to do so. Thank you.
It's a pleasure, Ben. Thank you.